listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to the Daily Gold Podcast. Thank you so much for tuning in. With me today, one of our favorites, returning guest, Vince Lanci from Echo Bay Futures. He writes the Gold Fix on Substack. And Vince, I want to get right into it. I have, one kind of smaller picture question, then a big picture question. But first, let's talk about the rollover of the contract, which can be really confusing. I mean, I do get confused sometimes. I get emails about this because, what you're looking at stock charts and various things on TradingView. There's some things that say the gold price is 1999.90, just a hair below 2000. But then you look at other things and it tells you the price is at 1959 or, whatever it is, somewhere in that region. So
right.
Can you explain what happened on Friday? I mean, as best you can, and kind of the difference between these contracts, because I know this is in your wheelhouse.
Yeah. Unfortunately it is. Okay. So if you're a chartist and you're looking at gold, or you're looking at gold prices, you can look at either the spot market, which is continuous. Literally, it doesn't change, right? It's just gold divided by the dollar, as you and I were discussing. Or you can look at the futures market. And most of us, myself included, will look at the futures market if we're trading in futures. And the problem, as you noted, is that on first notice or rollover days, chart packages have a problem handling the rollover, and different companies handle the rollover different ways. So this is kind of like a little bit of a quick education for chart people that are confused or that want to understand what's going on. Right. So let's say you're on a like TradingView, CQG, Ninja, Thinkorswim. They all handle the futures contracts different ways. So let's just try and define them very, very quickly. All right. So you have a futures contract. We're looking at futures, and that's where the problem is, right? And when you pull up a screen, you can either type in the name of the expiration, gold August expiration, however you would do it on whatever platform you're on, right? And then gold August expiration, when you're, let's say I'm a trader who trades futures and I have gold August expiration. Well, I'm looking at it. And the problem with it is when the market rolls into the next contract, when the next contract becomes more liquid, I can only trade on the next contract, in this case, December, but I'm still looking at August, and that becomes a problem. I have to remember to change my contract to December. I have to manually go in and say, gold December futures 2023. So all the platforms, the futures platforms over the years came up with a solution to that. And the solution was to create another input. You can input a continuous contract. So continuous futures contract. So what they do is all you type in is you'll type in, depending on the platform. I know that TradingView is, you would type in the code, which is GC for futures. You would type in the number 1, meaning the first contract in the continuous term structure, and you type in an exclamation point. And different contracts do it differently. Different platforms do it differently. So what that does is, when that day from August to December happens, you don't have to change your screen to December from August. It does it for you. So you're looking at what's called the front month continuous gold contract. It doesn't say what month it is, but it's August, right? So 6 months ago it was April. And then when April went first notice, meaning it was converging to spot and no longer liquid for trading, it went to June. And then what happened in June, it rolled into August. So every time you have one of these rolls in the marketplace, some of these platforms have a continuous futures contract that you can type in that will roll for you. It'll roll price for you. And the problem with that, there's a lot of problems with that. If you're a hardcore technician, that's a disaster. They're no good for hardcore technicians. What they're good for is lazy retail traders, which we all happen to be at one time or another. You're like, oh, I forgot to change. Well, if you're a hardcore trader, you know, it's like, oh, first notice today, because that's part of your trading. But long story short, so what you have is you have a lot of tourists, or you have a lot of people that aren't tourists, well-meaning people that are out there saying gold is up $40 today. No, it's not. You're looking at a continuous futures contract. You're not, that doesn't give you an announcement. We're rolling into December today. It just does it behind the scenes. And you have been given information that makes it appear. So one way to fight that, or to make sure that you don't get caught flat-footed on that, is to have on your gold screen, for example, you would want to have the first 6 months of expiration. So it would be GCQ for August, GCV for October, GCZ for December, and you would go down. You have all those there. And then underneath that or above that, you would have gold continuous futures contract. So you get to see each month and how it operates, especially if you're a TT person. TT Trading Technologies used to do this right, if I remember correctly. Anyway, so that's it. That's what happens. You get a lot of, for rollover day, you get a lot of bad information. And the problem is too many people rely on that without thinking what's going on. And they'll make statements like, Twitter's a cesspool for bad information. There's this one guy yesterday. I have to bring this up. There's one guy 2 days ago. His bio is it's not just Twitter, but Twitter's easy for me to describe. His bio is gold and silver aficionado, expert in futures trading and technical analysis. Now, sometimes when I find these, I will tag you and let you know that they're out there, but I didn't do it on this one because I almost took his head off. I just walked away from it. So that was his description in his bio. 76,000 people follow this guy. And then I looked at him and he was young, and I'm not doing it. It's not an age thing. There's plenty of young guys that know what they're doing. And I went, okay, so chances are he just doesn't know. He's not, he wasn't being stupid on purpose. He just didn't know. And didn't know what is the question. Well, his message, his tweet was gold is up $40 today. Does anybody know what's going on? Now, when your bio says, I'm an expert, I'm an aficionado in futures, and you ask a question like that in earnest, delete your fucking app, dude. You shouldn't be on the screen. The problem is 76,000 morons are going to follow him. And now they're not morons because they follow him, but they will be morons after they follow him because they're dumber for having listened to him. And that's me being the old man, get off my lawn type stuff. And it's not because I know more than him. It's because unless you are 100% sure, you don't say shit like I'm an aficionado. And nobody's 100% sure, Yeah, I know a lot about these markets, but I don't know everything. Anyway, so that's what made me, I think, throw a Twitter, a voice message out there. But anyway, that's how you deal with it. The problem with it, true technical traders have is they have a hard time rolling their numbers. So if you have a number in August, your number has to move to the December number. So you have to know what the August-December spread is on that rollover day in order to translate it. So it depends on how your numbers are. If they're moving averages, they're moving averages. But it's a big problem because I'm a Bollinger Band guy, right? And you can't use futures for Bollinger Bands on daily charts when you have behavior like this. It's a disaster. So what I will do is I'll do most of my analysis on spot. And I will pull the trigger in futures. So when I get a level in spot, I'll trade it in futures. And I'm always aware, I'm pretty much always aware of the differential. Now, and you have to be aware of the differential especially in a market like silver, not so much in gold, but you still want to know about it because the difference between the front month and the second month spread gives you an idea of physical tightness, But to the main point of the December thing is the gold contract trades every 2 months. They roll, so it's February, April, June, August. But for some reason, I know the reason, but the point is, for some reason, they skip October. Now, October is a legitimate month, but nobody trades it. And so we go from August to December, and boom, you get a $40 pop, and people are freaking out. But it's an illusion. It's not real.
So basically, I mean, looking at all these the charts that showed 1999.9, you have this big gap from the previous day. Those are wrong.
Right. They're the front month, the prompt most liquid gold futures month. And they're wrong if you are saying, oh, we just blew through support. We just blew through resistance in gold. I need to buy it. It's horrible. I mean, it happens all the time. And it's the other commodities that it's very, very pronounced in, but your listeners probably aren't really focused on them, is grains or natural gas, anything with seasonality. So yeah, the December contract, if you're using numbers that you developed in the last 60 days in the August contract, and you're applying those numbers to December, you're making a mistake. So gold wasn't up $40. Your numbers don't work anymore, and you have to recalibrate.
So yeah, just to put a button on this issue. So the charts that are showing 1999, that's an error. Will those eventually, over the coming days, will they revert to what they should be?
Oh yeah, I see what you're saying. Will they normalize to the old numbers? Is that what you mean?
Yeah.
Yeah. Will the December numbers normalize to the August numbers that you developed? Yeah, they will, but that's called contango. So the contango is going to decrease. So if your listeners can just kind of picture this, the spot market is trading, let's say 1950, and 19. Well, actually, we'll use the real number. The spot market trading 1959.35, right? The December market is trading 1999.90. Now that differential between spot and December is a function of time and interest rates. The higher interest rates go, the higher the gold price goes just on interest rates because of carry. I'm not implying that interest rates higher means it goes up. So
you're talking about the spread between the
exactly. That's the spread's the best word to look. Yeah, it's spread. The spread between spot, which you can get anywhere, and December is a reflection of the price of spot times an interest rate times time. So it's kind of like, hey, how much is gold today? Well, gold today is $1,959.35 an ounce. Well, how much is gold 90 days from now? Well, it's $1,959.35 times 6% times 90 days divided by 365. And you'll get a differential. And that's the mathematical differential. So to answer your question, like point blank, over time, if the market goes nowhere, let's pretend that the market doesn't move, right? Every day, the December contract loses about a half a tick. So the contango, which is a reflection of the spread, which is a reflection of the cost of money, will eat price out of that market. That's one of the reasons it's so easy to play from the short side. Because if you buy a December gold future and the market goes nowhere, it's going to lose $40 in 90 days anyway.
And that's why because interest rates are so much higher to, we were in a 1% world for, a decade or, a couple decades. And sometimes you'd have the rollover and people, it's like, there's like a $17 difference, or that's why it was so small compared to,
right.
What you saw on Friday, where it's a much like, oh, holy shit. There's, it's
exactly,
up $40.
That's right. That's
so
exactly
so back in the day, I mean, not to date you, but back in the, I'm sure you were probably trading in the 80s, but like back in the 70s and 80s.
No, I wasn't. No, I wasn't. I didn't start trading until the 90s. Keep going.
Okay. But I mean, from your wisdom that I'm sure the futures traders in the 70s and 8, when interest rates are 10, 12% or what, you probably had some
Oh yeah, no.
some big ass spreads between these
Yeah.
contracts.
Let's be clear. I mean, I'm not young, but I didn't start trading until the mid 90s. But I was familiar with this concept because I was working in finance before, but I became intimate with it, as you're implying, because the old guys were telling me, I'd be like, oh, how much, like I'd ask the question, why is the next month worth more than the first month? And they'd be like, carry. I'm like, what's carry? And I would just, I was the kid who was always asking why. And eventually I got someone who could explain it to me very well. And they did. And yeah, that's the bottom line. For the last 10 years, we've had 0% interest rates. And during those 10 years, the differential seemed minimal. We would roll and it would roll $3. It would roll $4. But that's 2 months. Remember, you normally roll 2 months. So it's June, July, August, September, October. But in this market, for this contract, which we should touch on, is the December contract is king in gold and silver. Absolute king. It's so powerful that nobody trades October. So it goes right from August into December. It's kind of like nobody cares about the October contract. Producers and end users don't care. And what ends up happening is not only do we have higher rates, which you pointed out, we also have a double rollover. So it's $40 when it should have been like 17 or 20. That's the other point. You're like, oh, it should have been about $17. You're right. But it was 40 because it's a double rollover. They just ignore the October contract. It's like the worst house on the block. It's a house, but you don't want to live there.
But okay, so even in the last time this happened, or let's think back before interest rates went up so much. I mean, the differential was probably like single digits, maybe, or close to that.
Well, the differential from
if it wasn't a double rollover.
Yeah, well, why don't we do this? If it wasn't a double rollover, cost of carry for a 60-day future. I mean, I'll throw it at you. You ready? I mean, watch. I'll just do this out loud because it's easy. Let's say gold's trading 1,800, right? And interest rates are 1% a year. For a 1-year CD, interest rates are 1%, right? So what's 1% of 1,800? So that's $18.
18.
Right? Okay. But now what's 1% of 1,800, $18 for only 1 month of the 12 months?
$1.50.
Yeah, exactly. It's $1.50. So your carry from 1 month to the next was $1.50. Even on a double roll from August to December, it was $3. But now we're talking about, and by the way, I mean, when you hear numbers like this, like it used to be $1.50, now the rollover is $10. It used to be $1.50. Now that, I mean, you're like, whoa, that's the beauty of, compound interest too. That's all part of our debt. That's a big problem. So yeah, it's quite a sticker shock.
Okay, yeah, let's move off of that because I have a big picture question. I know you've prepared an answer to this. And my big picture question is, if we're looking at what's going on, I mean, you had the stock market at a 27% correction. It's rebounded. It's going up. It's strong right now. Gold bugs, we have to admit that. No recession. You could say no recession yet, but I mean, it's fair to say there's not going to be a recession in the next quarter or two.
Right.
I mean, I guess I could be wrong, but that's what the market is discounting a soft landing. So you had this big, big decline. You have a soft landing, second highest tightening cycle ever. Maybe there's still another hike or two to come. I don't know what else I'm leaving out, but this is not an environment where gold is going to break out. But nevertheless, we're trading in the 1950s, which is what, like 6% from a new all-time high. So why is gold holding up so well when you have all of these headwinds?
That's interesting. There's several reasons. And before we get into the whole BRICS thing, without beating it to death, the reasons are focusing on government policy, meaning Fed and fiscal. The reasons are, well, first of all, starting with stocks. Stocks are outperforming gold. Let's use that. Stocks are outperforming gold right now for a couple reasons. One is we're in what you could call a bubble, an AI bubble. Artificial intelligence, whether you love it or hate it or believe it or don't believe it, is perceived to be able to make companies make more money with less cost. People get fired, AI replaces them. So stocks are discounting that. That's the first thing. So that's why stocks are running up. It started like a couple months ago. That's one reason. The second reason it's running up, stocks are running up, is, as you said, we don't have the recession that we thought we would have. We've had things break, but the fiscal side of the market has fixed it, rescuing banks that we thought were worth rescuing. The third thing, and this is a big thing, and now I'm talking about stocks, but now we can say stocks and gold, right? The third thing is, even though the Fed is raising rates, now this is just the way it is, this is the truth, right? Even though the Fed is raising rates as aggressively as we have, as you note, why are we not in a recession? Why are we not even seemingly approaching a recession? Those are the questions that come up. And the answers to that is because for every interest rate percentage point that the Fed is raising, the fiscal side of the government, the Treasury, is giving money away. And people, I think, your older viewers, people even perhaps a little younger than me, might remember this. In the 70s, the Fed chased inflation higher. And they were chasing inflation higher as the government was spending more and more money. Mostly social programs, welfare, things like that. We were having a rough time, right? But now what's happening is because of COVID and the supply chain damage and the fact that the world is bifurcated in a more mercantilist, Cold War II is a good way to look at it. Bad guys and good guys. Now we have to spend money, not money that we print. Well, we print it, don't get me wrong. But we have to literally spend money to rebuild manufacturing, to rebuild bridges, all the stuff we talked about for 10 years. We need to rebuild. We don't make anything. Well, guess what? Now we're going to start making stuff. Now, I don't know if we're going to make the right stuff, but the federal government is going like this. The federal government is giving billions of dollars to industries that it wants to promote. And those industries are electric vehicles, computer chips, core infrastructure. Now, you and I, we don't feel it. We don't see it yet, but it's out there. And I have a chart. I don't have it handy for you here, but I'll give it to you to give you we're losing manufacturing jobs, right? That's a common cry right now. But people aren't looking at how much money we're spending on manufacturing. It's
the manufacturing construction. Is that what you're talking about?
That's right. Yeah, that chart that I have. Yeah. I mean, that's massive. That's massive. And it hasn't worked its way into the economy yet. And so, you have to recognize that the information that people like you and me and others get is we're ahead of the curve now. We're no longer behind the curve with mom and pop retail. We're ahead of the curve. This is coming. So bringing it back home to what you're saying is the stock market, and we'll tie this to gold, is looking at the Federal Reserve raising rates and saying, they don't matter. The Federal Reserve monetary policy can't stop the tsunami that's coming. And the joke that I've made is that the Fed is a kite, dancing in a hurricane. And that's because the fiscal money is overwhelming. Now, the reason that we don't see it, or at least not yet, is because they don't say it. They don't say we're printing $1 trillion and we're giving it out. They put a bill out there. The bill says $1 trillion in stimulus are going to this, and this industry, and you don't hear about it anymore, right? So Powell raised interest rates 1%, and I'll give you to make this easy to understand and a more holistic thing is Powell is raising interest rates, which takes money out of the money pool. The money supply is shrinking. So all of us in the pool lose an inch of water. Okay. Then the Fed comes along, not the Fed, then the government comes along and picks individual swimmers and gives them more water. So it's a bad analogy because we're talking about, it's a special favor, it's a subsidy. So the government, the Federal Reserve is hurting everyone, and the federal government is helping someone. And someone that's getting helped is, keeping employment up, is keeping demand up. So while you and I aren't going out buying our Costco beach chair sets, with that extra money because we don't have it, that extra money is going to, a chip maker, and that chip maker is being encouraged to hire more people with that money. One other thing I want to add, because this will bring it really home for gold now. So gold is rallying on the basis of that. Okay, gold is rallying because the Fed doesn't matter. We really are in a long-term, chronic, anti-Goldilocks inflationary environment. Now I'm going to give you something else that no one else is talking about, and we're going to talk about it. The PPP program during COVID was so successful and there was problems with it too, but so successful in helping small business people survive. Like there was a guy in my neighborhood, he had a hot dog stand, and it literally, like, it kept him open. It was so successful that they've reinstated it. And they don't call it PPP now. And they're not going to tell you it's PPP. It's called ERC, Employee Retention Credits. Employee retention credits are, hey, if you keep your employee, we'll give you up to $26,000 per employee. Now it's a tax credit. It's not a handout up front. But what it's doing is, if I'm Amazon, I'm not going to fire 5,000 people if I can get them to work for less. You get these tax credits. So everything that's coming out of the fiscal side, which is much harder to quantify for guys like us because we don't see the data on a daily basis, is inflationary. That's why gold isn't backing off. That and the brick stuff. So if the Fed were to lower rates, gold's going to new all-time highs. No doubt in my mind. In fact, I think it's going to go there anyway, but for different reasons. So that's my long answer.
Great. Well, I had a follow-up and you just answered it because my follow-up was, okay, well then what is actually going to push gold into a breakout? Is it, finally a recession where the Fed has to cut, or maybe even the Fed cuts before the recession? Or is it, we have a soft, it's a continuation of what we have here, and eventually, inflation expectations start bumping up again, and then people get even more worried, and then gold breaks. So I know I'm just rambling on here, but you answered that question.
No, but
I'll give you the floor to provide some more color on that.
No, you see, we're moving away from the big picture towards the more tactical, which is what I wanted to talk to you about, right? And
I'll just interject because not you, but because gold has this beautiful setup and all that, and just lots of people, not just on Twitter, but I could feel it. Gold people, they know that gold's going to break out at some point and make a huge move high. They know the big picture, but they are so effing sick of hearing, all the bullish fundamentals and all these things. And they're seeing the stock market go up, and, silver is down so much from us. Like, they're so sick of hearing all these things. So that's why the tactical stuff is good. That's why I had that follow-up that you already answered. But I'm editorializing here, but that's why the tactical stuff
I totally hear. Like
granted, we can't predict to the month or the day or even the quarter of when it's going to happen. But it's good to have these tactical conversations.
We have to, right? Because if not, we'd go crazy. Like, I could just pretend like your listeners are listening and you and I are just going like this. Well, it's just a matter of time. Gold will go up. Well, there's inflation around the corner. Well, that's bullshit. They're tired of hearing that. They want to hear something,
And sorry to add one more thing, because I'm more on the stock side. You're on the future side,
right? Because
the stocks and juniors, there is a time decay. Like, silver could break 50 and go to 100, but if that doesn't happen for 5 years, let's say, and you're a silver company right now preparing for, you got to dilute yourself for the next 5 fucking years to wait for that. So in my business, there is a time decay for all these companies that go. I'm not saying it's going to take 5 years, but that's why the timing. That's why the time, and even for the big companies too, because mining is expensive. It's capital intensive, so that being precise on the timing really matters for these companies. Because some silver companies a couple of years ago, I'm not. They or some executives or whoever, they probably thought, oh yeah, silver's going to go up a lot. I'm going to buy some silver deposits. Or let's say they did that in 2016. They had one or two moves, but now it's been almost 10 years. They've diluted themselves to oblivion almost, and they're still. So I know I'm editorializing, but I'm just making the point why, at least for my audience, why time decay is a huge factor.
I didn't even know that, because I don't do the equity side, but that makes sense. On the future side, your time decay is that contango that we talked about. From month to month, you have to pay money. It's like a contango tax.
Right.
But on the equity side, that's right, because these people are laying out money. They're paying expenses. And by the time the move comes, they could be what's the word you use, diluted. They could have issued too much stock because they needed to keep running. They could have taken down reserves. And that's right. It's brutal, right? The time decay. Yeah, mining. So
anyway, the tactical, I don't mean to editorialize and get you off your thought, but that's just in my world why the timing it's important, and why a lot of investors, myself included, you hear all these gold, like I said, you hear all these gold bullish things, but it's like, okay, well, yeah, when the F is this thing, is this thing going to effing happen?
Right.
So, and like I said, I know we can't, you can't predict to the day or the week or the month, but that's why moving to the tactical. That's why I asked you about, okay, what is the reason gold will break it? Like, what is, yeah. So anyway, I'm sorry to babble on here.
No. This is great. This is good. This is good. Okay. So we're moving into, we're now in the time of year that the market, okay, why don't I just go through it? All right. My observations are going to be slightly technical and very flow oriented from the information that I'm getting from fund players, and a little bit of seasonality. Okay. So why don't we start with the market call? If the market gets above a price, now I would have said 2,000, but the December roll screws that up. There are buy stops above this market. You've got to, as opposed to, here's what I'm talking about. There is a growing, you mentioned it, but it's not just at the individual level. There's a growing consensus among big macro fund managers that know that gold is going to go up. All right. Now, before we get too excited about it, but they manage much money, and most of it is somewhere else. The word now is and this is not a prediction, so it's not like one of those idiots going out there, tomorrow there's going to be, no. A lot of fund managers have an alert set on their screen. And the alert, for me, the alert is last week's high. All right. So last week's high in spot was 1987.53. All right. If we get so I'm going to give you a number, my number. If we get a weekly close above 1987.50, I'm not saying we're going out. There's a difference. I'm saying this. If we get a weekly close above 1987.53, there will be a massive amount of buying. And that will come from speculative and macro funds that want to position themselves for the next move higher. Okay. So just assume for this conversation that what I just told you is a fact. All right. Tactically, how am I going to trade that? And then I'll get into why I think it will or won't happen. Tactically, in the past, in gold, when you have a situation like that, and they happen once in a while, you have your buy stops building up right above the market. But it's not small bullshit money, it's big money. So it's the smart money that wants to get in. They're trading bonds, they're trading oil, and what they do is they set their alert for gold and they don't look at it. I don't care about gold until it gets above this price. Don't bother me with it. It's a rerun until it gets above there. Gets above there, they're going to be putting orders in. There's going to be a lot of those orders coming in. Now, if I know it, the banks know it. And if the banks know it, then everyone is ready to do it, which means there will be buying. There will be buying at that point. But if in a healthy market, and gold is a healthy market now, whenever you have buy stop orders above a market, you start to get sell orders above that because they think these are good levels to get out, because that's how they operate. So tactically now, if we get a weekly close above 1987.53, I'm going to add to my longs like the macro funds are. If we go back below 1987.53 by a measured amount, I haven't decided what that amount is yet, I'm going to get out and then I'm going to reverse. Because what I fear is that we have a high, all this money comes in, and for some reason, Russia is there selling because they're not making money in oil, and gold gets hit from a selling order, and the market comes off because it gets absorbed. We used to say there's a lot of buying there, and it got absorbed by someone. We don't know who, but the seller is stronger than all these buyers, and the market comes off. So I'm saying 1987.53 is my inflection point. We get a weekly close above that. Now, if there's a daily close above that, maybe I'll buy a portion. If there's a 2-day, but that's it. So tactically speaking, you need to find a level that you think, if you're trading this, or if you're just watching it, there's a level that if we get above it very soon, you're going to see impulsive big money, not impulsive small money, impulsive big money plow into gold. How patient they are, I don't know. Now, why am I more confident than normal this is going to happen? Because of the BRICS thing. I want your listeners to think about this BRICS event, which we're not going to get into right now, because, we've talked about it before, right? Unless you want to. I want you to look at the BRICS August 22nd event like it's a debt ceiling. What happens when there's a debt ceiling potential crisis? Gold gets bought, gold gets bid, dips get bought, dips get bid. The market runs up until they solve the crisis, and then gold sells off. Well, I want you to look at it this way. No matter what the news is between now and the August 22nd announcement, even if there is an announcement, there's going to be buying of dips. So between now and August 22nd, if we get above 1987.53 in spot, we're probably going to run. We're probably going to make new highs. It could be buy the rumor, sell the news, but that's it. So we have a catalyst. The reason I'm not naked, crazy bullish, like if we get above 1987.53, I'm going to buy it. And if we get back below it by a significant amount, I'm going to get out and get neutral, maybe get bearish, is because there's one factor that's making me careful. You've got a market that's poised for new all-time highs. You've got buy stops in this market right above here tactically. You've got an event to be the catalyst to get us to make the new highs. And what else do you have? You got August. And historically, gold makes a high between August and October and sells off until November. So we could go up and we can keep going up. But if we fail, if we make this new high in reverse, I'm not going to get caught long. That's how I'm looking at it. I'm not afraid to play short either. So gold is, I got to tell you, I'm so pleased with how gold's behaving, because all we've been seeing now is Bitcoin this, Bitcoin that again. The Bitcoin spot ETF is coming back. Nobody's talking about gold except Goldman. They mentioned something. I'm like, I'm paying attention to that again. But all the thunder should be stolen from gold, but it's not. That's because of this brick stuff. So that's it. I'm bullish above that price. I'm neutral if it goes back below that price, and I'm bearish at a price below that. So right now, I don't care. You follow? Like right now, I don't care. I'm not looking at it. You want to look at a trend line on the weekly? That's great. You want to look at one on a daily? That's great too. Those are all great levels. The daily looks like a bull flag that might be getting a little bit too long, or a wedge that's broken out. Who knows? But, gold has everything in place for a rally. So why hasn't it rallied yet? That's what I'm worried about.
Yeah. Okay, so to follow up, so a weekly close above 1987, and you say it could run. Are you just talking like a couple $100 or less than that or more?
Well, I don't like to put targets in, but I'll tell you what other people are saying, right? New all-time highs and 20 low scenario 2,300, high scenario 2,500. That's JP Morgan. That's their good stuff, not their bullshit analysis. That's good stuff. Goldman, they'll put prices out after they're long. They haven't prices out yet. So when they get long, when they get a price,
and after it breaks out too.
Exactly. When Goldman, when I get a price from Goldman, I'll let you know to let your listeners know, because hey, you know what? It might be time to get out if they're putting prices out. So I don't have a target price wise. I think a real technician should give you the target there. But I will say that the buying should take us up to, new all-time highs. JP Morgan says 2,300, 2,500, and I tend to agree with them on these type of analyses. But every day that goes by between August and October that we don't make a new high, I get bearish. That's my answer.
Bearish just for the
season.
For the next the next.
Oh yeah,
months.
by bearish I don't mean zero.
Yeah.
By bearish I mean I'm not buying it until Thanksgiving, unless something else happens. Because I look at the market in a very seasonal way.
Right. Sounds good. Well, I think we should leave it there for today, unless there's something else you want to mention.
Well, there's something else tactical I want to mention. Last week, the open interest, really a lot of longs got out in gold. Like 35,000 lots. So considering that the longs got out and we had that big August rollover to December, and the market didn't really crap out, it's kind of encouraging. So that means there's people who can get back into the market. That's all. So that's that's pretty good as rollovers go. It's encouraging.
All right. Great stuff as always. Please tell the listeners where they can go to follow you, the Gold Fix, Twitter,
sure,
etc.
Gold Fix. If the Daily Gold listeners are listening to this on YouTube and they go and sign up to Gold Fix Substack.com, goldfix.substack.com, I'll give you the link as well. I'll give you 2 weeks free premium, and you can see what Jordan and I are seeing every week, and no credit card or anything like that. You just have some fun with it. You can take a test ride. Twitter, Soren the K, but that's not really that's not something I advertise too much, at least not yet. Anyway, that's it. Thank you for having me on, Jordan.
Always great to have you on. Thanks so much, and let's see if we could do this again. In the next couple months, maybe the end of summer.
Hey, wait. Why don't you tell me your levels? You're the technician. I want to know your levels. What do you think?
Well, I mean, I think on the weekly, I've been looking at, 1985 to 2000, just to kind of to use more round numbers or multiples of 5. I mean, that's what I've been saying, 1985 to 2000. The interesting thing is, and also on the monthly, like 2000. So it's interesting because we have one more day left, and some of these, if these, the charting services, the charts that are showing that they haven't corrected, for that $40 move.
Yeah.
Like you could be, if gold has a good day on Monday and some of these charts don't correct that, like they're going to be showing a monthly breakout.
Oh, that's right.
Because I think the monthly, let me look here. I think the monthly all-time high close is.
Oh, that's hilarious. You're right. I'm looking at it.
I think the monthly all-time high close is like, it happened in April. So
1999.
Yeah, 1999. So those are basically my levels. I mean, looking on the weekly, 1985 to 2000, kind of that range. And on the monthly, it's 2000. So those are my levels.
Wait, check this out. You don't have to show it if you don't want to, because I know you do your thing, but here's so on the right is spot. That's the real market. And on the left,
that's the futures.
the futures are broken out on the monthly. Oh, that's ridiculous.
Oh yeah. Yeah, I guess you're right. Yeah, because it looks like the all-time monthly high was 99 and 10.
Right. It would be,
So
this
now
would
we're
be
80. Yeah, we're 80 cents above it.
yeah, look at that. Look at that. I mean, that's pretty funny. That's not a breakout. And that's by the way, that's the thing. Stupid money will buy it because of the technical breakout, but they're not so stupid if they're right. You know what I mean?
Yeah.
So,
but the other thing is, I look at the gold against the stock market ratio a lot, and that's just been ass lately. So it's really, I don't know if we're going to see any huge sustainable move higher unless the stock market has a big correction.
wait. You're saying that based on the gold versus the stock market chart that you look at,
Yeah.
that it just looks too healthy for the stock market right now compared to gold?
Yeah, I mean, yeah, that it's just because that's kind of my thesis. Like, how is gold going to make a sustainable breakout if it's underperforming the stock market?
Right.
And
Right.
Because too much money is going into stocks, and if you look at the positioning, like there's still more people that have to get in to the stock market.
I think that you're touching on something that's really important. I don't think people get. When the market is in a bubble, by the way, we're in a bubble in stocks. I'm not saying it won't be valid for a year, but the reason we're in a bubble by definition is because when the stock market is going up, as interest rates go up, interest rates win eventually. So that's what happened in 99, 2000. But to your point,
and also I heard Louise Yamada, legendary technician, saying this on an interview. I think she said when the 10-year went above 5%, I think in 1968, like that's when the market crapped out.
Really? Okay.
So it's also, well, and it's really, because I was thinking about this, because I mean, they think about the 70s in terms of inflation. They don't think about the 60s. I mean, inflation had this big breakout, 64, 65.
Yeah.
And gold stocks did really, really well. And so my contention is, if the gold price was freely traded, it would have broken out in 64 or 65 instead of 70 or 70. It's just the first move going off the gold standard to 70. It wouldn't have been as strong.
Right.
Because it would have broken out earlier. But anyway, my point is, you had a breakout in inflation in 64, 65. We've talked about the similarities between the late 60s, where the Fed inflation went up, the Fed had to tighten.
Right.
But that first wave did not break the stock market. And so it makes sense, given what Louise Yamada was saying, how I think when the 10-year went above 5%, that's what kind of broke the market then. So I mean, there's two things. It goes into your point that interest rates, they will win eventually. Like they will cause a bear market in recession eventually. But the other point, which I've been thinking about is, the stock market still went up with the first wave and made a new all-time high. So it's really the next wave that's really going to be,
right.
And we're just not, and you have to have like a view of history that's like 100 years to understand, because you look at regular charts online, you can't see like 50, 60 or 70 years worth of data. You can't say, show me the history of this, it only gives you 10 or 20 years. But that's interesting to me how, the first wave of inflation, the stock market still went up.
Right.
But then, and so, I'm piggybacking too much on the point that you're making, which is eventually interest rates will win out. And that's my point, is you get the next wave, the next wave of inflation, interest rates, bond yields go higher. That's what breaks the stock market. And then that's when you get a lot more, then the money really starts chasing hard assets and all the inflation stuff. but it
That's
hasn't
right.
it hasn't happened. And it's interesting because I look, the being on the gold standard, it kind of messes up the comparisons, but the last 5 or 6 years, very similar to what was happening in the mid 60s, where the stock market was still going up, but energy was going up, gold stocks were going up. So
Well,
yeah, I don't know where the point started, but
no, but your comment about inflation is right. Right. We just had our first wave of inflation, and the stock market is rallying in anticipation of the Fed easing again. What happens if they do ease again? Stocks will explode, right? That might be the end of your first phase you're talking about.
Well,
But
I've been thinking when they cut, like the market will peak. The market will peak when they start cutting.
right. But the other thing is,
It's counterintuitive, but it makes sense because why will they start cutting? Because the economy is getting weaker. It's going into a recession.
Right.
Inflation is, there's statistical stuff on inflation. Inflation's coming down. It's like, yeah, no, it's not. Like, are the price increases
right.
from the last like 2 or
Right.
3 years coming? It's so ridiculous.
Exactly. There's one other thing. This is not for me, but I want to share it with you. We talked about this before, but we're not in a recession until housing comes off. And a buddy of mine in the real estate side says he doesn't think housing's going to come off significantly. So if housing doesn't come off and people don't get fired, which is apparently they're not getting fired yet, then we don't have a recession. So does the Fed really ease? Maybe for 6 months they do nothing. That would be pretty cool. And I say cool in the sense that people will be freaking out. They won't know what to talk about.
Yeah. Well, because the market is still pricing in lots of rate cuts in 24. And even the Goldman Sachs economist was saying he thinks they're, of course, they've been no recession. They've been right, but he was on CNBC and the clip, he was saying that they will have to start cutting. I think he said the second quarter of 24. Well, I guess that's more than 6 months away, but he said because real interest rates are going to be really high.
Right.
Because inflation statistically, I always say statistically because people get confused. Statistical inflation is coming down.
Right.
But real inflation is not.
The rate of which your pocket is emptying is slowing down, but your pocket's still emptying.
Yeah.
Exactly.
Yeah.
Exactly. Cool. Thank you, Jordan. Thanks for having me.
Thank you for tuning in to the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.